Good morning, Richard Calhoun, Creekside Realty, 40 years of working in real estate here in Silicon Valley with buyers or sellers. We're here to talk about real estate in 2022, week number 1. Welcome to the new year. We have new URLs. The green is still the base URL. It has changed. It's not just 6 letters, Silicon Valley Real Estate Market Graph, so SVREMG, and then the year 2022. The handout is posted, so after the root URL, you add the letter H for handout 2022-01-08 for the handout. And it was posted. It was posted about quarter to the hour, which is just about my target time frame. Then below the line are how you get to archives. To get to all the archives, you just drop off the year and you simply go to tinyurl.com/SVREMG. To get to a specific episode, you put in the year, month, and date. Keep in mind, if you want to go back to an old one, you have to use the URL from 2021, which is here with the cross out. Having said that, let's get into the data. Here's the first data slide. It's 3 lines showing 2 things. We also have to do a little explanation. Last year we were working over here because we were in week 51, 52. Now we're at the beginning of the year. We have 2 data points on here because Excel won't plot a point. And so I have 2 weeks for week number 1. We're skipping a week to give you the separation, and then we have weeks at the end. So right now, to get to a year in 2021, you have to subtract 2. So this is actually in column number 4. Therefore, subtract 2, it's really week number 2. So you go from this point right here to that point right there on the gray line. So what's all this saying? You have 2 things. You have supply and demand. The supply is the available listings, the blue line. So last year you were up here at 140% of the 5-year median. The 5-year medians are 2015 through 2019. So you had more inventory than you normally do. This year, we're starting off with about 63% of the 5-year median. Then you look at the new listings coming on the market. That's the gray line. Last year, we had about 125, 130% of the 5-year median. This year, we're at something like 97% of the 5-year median. So you're almost having the right number of listings coming on the market you'd expect. Those 2 things are on the supply side. One is the new supply coming on that's most likely to sell. The other is the supply that's been in the reservoir on the market for a while and has been picked over and less likely to sell. And the available includes the new, so it's the cumulative of everything. Flipping over to the demand side of the supply-demand curve is the red line. The red line is how many offers were accepted in the past week. Last year, we were at about 135% of the 5-year median. This year, we're only at 80% of the 5-year median, and that might sound negative for a lot of people, but I will try to convey that, in my opinion, and based on the data that I see, the reason the demand is lower, and this is sort of the first time it's been lower, there was essentially no inventory to sell for the past week. If you can't sell anything, then you don't have offers accepted. This is looking at days of unsold inventory. Days of unsold inventory is the ratio between the supply and the demand. So you can see last year we were just above 40. This year we're somewhere around 34. So we're quite a bit hotter than last year. The difference between, something like 41, 42 down to 34 may not sound that much. It gets harder and harder to decrease DUI once you get below 40. You can see we've gone down here around 20 and 18, and down over here we got down to around 15. So it can be done, but it is difficult. So I'm just trying to point out the difference between 34 and 42 may be more than the number itself sort of suggests. This is looking at what the buyers are feeling. This is the sale price to list price ratio for each transaction in a given week. Everything's on here is weekly data except for the 2 outer lines. The blue line down here is the worst month we ever had, and the red line up here is the best month we've ever had. That is monthly data. Then there's 22 weeks of data in here going back in time. So the most recent week is the purple week here. And so you can see it's clearly at the top of the line. So we're having the best week as far as overbidding, or if you're a buyer, maybe the worst week in the terms of overbidding that we've had in the last 22. And you can see the dotted lines are the oldest. They tend to be down here, followed by the dashed lines that are next, and then the solid lines, which are the most recent 8 weeks. So the trend has been basically up. If you look at it within that, there's been a fair amount of bounce, but in general, the trend has been in one direction, and that's been up very slowly with some bouncing and fluctuations. This graph is showing the key indicators and what you need to get the key indicators. And this is for the past week. You have this week and last week for comparison. We're starting off with inventory, which gives you an idea of what's available for the buyers to purchase. Last week, we were down at 34%, call it 35% of the inventory for Santa Clara County single family homes. Now, that's the single biggest micro market. If there's only 35% of the homes that you'd expect, of course, you'd expect the number of sales to be impacted. There simply isn't the properties for people to purchase. I know in my own business, I have taken people that were looking in Santa Clara County into Alameda County and San Mateo County, not necessarily because the prices are lower, and that especially in San Mateo County, but because there was more inventory available for them to pick from. And they are purchasing outside of Santa Clara County single family homes because they can't find what they want within the county. When you have that kind of activity going in, the demand is really here, but there isn't the supply to meet the demand. And so when you measure the demand based on successful offers accepted, boom, it drops when you don't have any supply. So that's my argument. If I was able to get reliable information, say on the number of offers being presented, that might be a more reflective of what the true demand is. That data is not available. Then if you look at San Mateo County, it's at 90% of the expected level of inventory, up from 55. There's been a huge increase, and a lot of this is the holiday week activity. Last week with New Year's, there basically wasn't any new listings. There wasn't any new sales because of that. And so now this week, the new listings have come on the market, and inventory got down to, I think the number was 154. So in all of Santa Clara County, there was only 154 available homes. We're already up to 220. So you've had a 50% increase in the number of inventory available. That's going to lead to a large increase in the number of sales this next week, which will impact all the data. And that's one of the things with holidays and looking at real estate, you can see the huge cycle that it has. Going down to townhouses, you're at 109%, 110% in Santa Clara County, up from 67%. And in San Mateo County, the Bay Cities, I meant to go back and check my baseline to see if I made an error in calculating that, because this has been significantly above, roughly about twice the level of inventory you'd expect, which makes me think something's wrong, especially considering the other data. So that's what you can tell from just what's on the marketplace. Then when you start looking at offers, you can get days on sold inventory. That's the rate of sales. You can see last week we were 11. This week we jumped to 16.6. Again, I'm not worried about that. It's the holiday fluctuations. It's going to increase probably again next week, because you go back, I go back 5 weeks on this data, I believe. I have two sets of data, one that I only go back a week and one set I go back 5 weeks. I'm pretty sure this is the second that goes back 5 weeks. And so you're getting more and more influenced by the holiday in those 5 weeks. So I'd expect this DUI to generally go up. We're going to have a lot of sales start coming in next week. That will tend to put downward pressure, but I'd expect this to go up for one more week and then reverse and come back down. And again, you can see San Mateo County went from 11 to almost 18. Condos and townhouses are a little bit slower, showing the same trend, 15 to 24, 18 to 25 days of unsold inventory. Then you move over to overbidding. To get overbidding, you need closings, so that data lags behind. Sellers in Santa Clara County are basically getting 81% of the sellers are getting over their asking price, up from 79. In San Mateo County, it went from 75 to 75.5% in rough numbers. In the condos, it's a little less, but still pretty aggressive, 65 to 65.7%. The condos in the Bay Cities actually went down from 66 to 60%. Again, anytime you have more than 50% of your sellers getting over their asking price, I consider that to be a strong seller's marketplace. Between 33 and 50, I consider it to be a balanced marketplace. Below 30 would be starting to be into a buyer's marketplace. You can see we're very strongly into a seller's marketplace. Then we also look at the other type of overbidding, and that's the magnitude of overbidding. How much are buyers overbidding in order to get a property? You can see we jumped from 111% to 112%. San Mateo County jumped from 110.5% to 111, sorry. And it's also noteworthy that historically San Mateo County has outperformed Santa Clara County. That is not what's happening. On all these benchmarks, Santa Clara County is now outperforming San Mateo, and that has been true basically since the pandemic was announced. Then you go down to townhouses, still getting aggressive overbidding, 104% to 104.2%, 104 down to 103.7. Still not as aggressively, but the balanced range, in my opinion, is from 99 to 101.5. So we're clearly above 101.5 on all these groups, which puts you in a strong seller's marketplace. The comment before was, if you look at all these being in strong seller's marketplace in San Mateo County, it doesn't make sense that you have triple the inventory, which is why I have said this for a couple of weeks. I just need to take the time to go back and verify my 5-year base data, because I have verified the current data. So that's not where the error is, if there is an error. But supporting the fact that you may not have an error is the amount of appreciation. It's actually down. So prices right now at the beginning of 2022 are down 4.5% from 2020. I have not updated my base from 2020 to 2021. I will try to get to that this week. This isn't necessarily a trend in the last week, because this now is not last week's number, but the peak number for the year. Typically in the single family homes, especially, you tend to go up and you overshoot. So the peak is only for a short period of time. So the fact that you're down at 20.4% doesn't say the prices are dropping right now. In San Mateo County, the drop is even greater, from basically 24.5% down to 10%. And in the townhouse marketplace, which tends to be more stable, and this would be fairly consistent of what I expect, 19% down to 13%. But in San Mateo County, going from 16% appreciation on August 27th to minus 4.5% appreciation is not what I would expect, which would tend to support the number here of having triple the inventory, or almost triple the inventory you'd expect, or double for a longer term. But all these other indicators indicate the market's aggressive. So that's the sort of the quandary of the data. And one of the reasons why it's important to have a lot of data is you never know what data is the most meaningful. And it does vary from the real estate cycle throughout the year. Like when you're right at the holidays, DUI is impacted quickly and aggressively, but for a very short period of time. So it's one of the first data points to come back. Median and average days on market don't get impacted that much by the holidays, but are really lagging indicators the rest of the year. Here's a table that I'm not going to get into huge detail, because we'll come back right after the break, but it will give you an idea of what we can get into. These are the different micro market areas in single family homes in both counties, and then the condos in both counties. The key indicators that I've talked about: DUI, days of unsold inventory, the color, the redder the color, the lower the number. Again, Foster City doesn't have a single home for sale currently, and for probably close to 2 weeks, or maybe even 3 weeks now, for a significant period of time. There just is zero inventory. The frequency of overbidding, the same concept. The numbers are here in each one of the different micro market areas, and then the redder the color, the more aggressive the overbid, more common the overbidding is. And then the magnitude, the same concept. The more the buyer is willing to overpay, the redder the color. And then on the pricing, it's a little different. It's not hot, cold marketplace, it's price. So the median price is the white color, which is Redwood City. The median number is the middle number. The number to the right is the highest 10 percentile in that area. Call that the 90 percentile. The number to the left is the 10 percentile, the lowest 10 percentile number for that particular micro market area. And then for the county data, I don't graph that on the maps, because it would be the whole map. And to make it jump out, I report that in thousands of dollars versus millions of dollars. And that's why there's a K that gets cut off here. You can see it up here in Santa Clara County, where everything else is million. So that's it for a quick recap of this week data. Go back to the URLs, pause for a minute to see if I have any questions. Seeing that I have no questions, I'll move on. Okay, how does a consumer use this data? There's 2 ways. One, you can come over here to the price area and find out what your price range is and what areas you can afford to purchase. And then you look at the conditions in that area. If you're a seller, you find your micro market, and then you find out what kind of conditions you're experiencing. So like if you were a seller in San Mateo County, County and the Bay Cities. Your days of unsold inventory is only 9, extremely low. Your overbidding is 86%. Your overbidding is at 14% above the asking price. The price ranges from 1.33 million to 3.5 million. So basically, as long as you're within that price range, you can be pretty aggressive. You can, set your expectations high. You can expect multiple offers. But again, one of the things that's sort of bizarre about this real estate market, and it's controversial, what's the best way to get the highest possible price for the home? If you price it where it's really going to sell, the buyers don't come in and offer you your asking prices. They're expecting to overbid. So what I like to do, and in this marketplace, I drop it down a little bit more just because, like in the Bay Cities, we're talking about you're having a 13.5% overbidding. So, if you're a seller, you figure out what market value is. You might not subtract off 13%, but you might subtract off 5 or 10% from that so that the buyers come in. And then if they overbid by 13%, you're getting more than you thought you would. I think the ideal way to go, we're away from psychological pricing where people go in, see a flyer, make the decision on that. It's all internet basing. So I like to figure out market value, find a round number below that consumers might be using for an upper or lower end price point, and then use that price to do it. Obviously, the seller has to agree with it, whatever price you come up with, but you don't want to just go in with what you anticipate the sale price to be, because buyers just aren't expecting that. They're expecting to overbid. And if they see your asking prices at market value, and if they're figuring they'll have to overbid by 10%, then you're priced too high. So it's sort of a crazy thing where the buyers are so burnt out because the market's so hot that they don't look at your asking price. They look at your asking price and then add quite a bit to it to determine what they think the sale price will be. Here is looking at each individual components. The two lines here are, the yellow line is the 5-year median. The blue line is the current data. It's looking at the number of new listings that are coming on the market each week. So basically last year you started off with exactly the right number of new offer listings coming on the market each week. The latter part of the year, basically from Labor Day on, you had slightly more inventory come on the market. Right now, and it's only 1 week, and the holiday week, etc., you're a little bit below the level of what you'd expect to come on. And it's pretty telling in the micro market area where you had almost 300 homes come on the marketplace. And I think there's only 550 homes in both counties, both types of properties. So 2/3, 60% of your inventory has been on the market since Saturday. And very few people list on Saturday, Sunday, Monday, Tuesday. So 60% of your inventories come on Wednesday, Thursday, and Friday. So that says something right there, where if 3 days are 60% of your total inventory, that's pretty insane. This is looking at the total inventory. So that was how much new listings are coming onto the marketplace. This is how many listings are on the marketplace at any given time. So you can see the 5-year median is up here somewhere around 800 homes, and you can see the numbers just over 500. I think it was 550 is the number I believe I saw. This is the number of new offers accepted. Same concept. The number of new offers accepted is below the 5-year median. And again, I'm going to maintain that that's because there simply wasn't any inventory for people to purchase. This is looking at days of unsold inventory over time. You can see that at the end of the year, we were basically getting down to the record low numbers where we've never been before. But now look at this huge spike. And that's what I was saying earlier. With the statistics, each statistic helps you determine other things. DUI is a very sensitive indicator, but when you have holidays and you have mass number of buyers just not interested in the marketplace doing other things, your DUI rapidly goes up. This particular week, a lot of that increase in DUI is not the buyer's side, but there simply wasn't any sellers out there or any listings out there for the buyer to buy. And if there's nothing for him to buy, he can't buy even if they want to. And I am saying that's just, it's anybody that wants to buy. It could be any of the different sexual orientations we have. I'm a complete equal opportunity real estate agent. Here is your map showing the different days of unsold inventory in the different areas. The redder the color, the hotter the marketplace. The white color is basically a balanced marketplace, no color from 42.5 to 77, and it's at almost 60 days of unsold inventory. But you can see the range that Foster City has 0 days, and that's because there are no listings available in Foster City. But anything below 7 is saturated red. So 8.9 is going to be pretty close. These other ones are a little bit less. It's a little irritating. To me, that's red, but I don't know how to get that shade of red in the software I'm using. I'm only getting this shade of red. Maybe I'll even ask the software guy to see if he can help me out on that. Moving on to the frequency of overbidding. Frequency of overbidding is how common. You can see that in 2022, we were up here at almost 80%. Last year, we were only at 57%. We got up and we finished off the year up here around 75, 80% most of the time, basically from fairly early on, week number 16 or something like that, maybe even 15. So that's somewhere around, the end of April, because so mid-March on, we were basically in the 75 to 80% of the sellers getting overbid. That's where we're starting off this year. It's going to be interesting. It's hard to believe that it can go up from there, and I would tend to think it's not, but it may be a fairly constant line all year long instead of increasing at the beginning part of the year. This is again the frequency of the three major components. That's single family homes in Santa Clara County, the red line, San Mateo County, the gray line, and condos and townhouses in Santa Clara County, the yellow line. Obviously some bad data points in there. You just simply ignore those. And you can come over here and you can see that Santa Clara County is outperforming San Mateo County. And if you jump back before the pandemic, and this is actually about a month off, which should be back about here, you can see that the two counties were sort of performing on top of one another. But before, this is sort of the historical picture where San Mateo County was outperforming Santa Clara, which is what you'd expect. Part of this is because, the market was changing before the pandemic, but then the pandemic really made a big difference because you can see the dip here where Santa Clara County kept going up. Basically, with the pandemic and remote working, people don't have to pay the premium price to live closer to work, and they're fleeing to Santa Clara. And I think that's why Santa Clara County single family homes has done so much better than the other types of properties in the other geographical locations. This is the frequency of overbidding plotted out. Same concept. The white areas are sort of a balanced marketplace, and you can see two areas that are white because they're between 33 and 50% of the frequency of overbidding. So basically a third to half the sellers are getting more than their asking price. And those two areas are both in San Mateo County. You got the expensive areas right on the Santa Clara County border here, Atherton, Menlo Park, Portola Valley, and Atherton. And then also the coast area of San Mateo County, where it's just a little more inconvenient to commute in and out of, which makes it a little less desirable. Making it a little bit more affordable is also less aggressive marketplace. This is the magnitude of overbidding over time. You can see last year we started off around 103%. We quickly got up to around 108%. Towards the end of the year, we were climbing up and we got up to about 110%. Now we're just over 111%. So this is a pretty strong indicator. This does have the ability to go up, unlike the frequency of overbidding. Will it get up to about 114, 115%? I would tend to think it's going to, but only time will tell. This is the current distribution of the magnitude of overbidding. The redder the color, the more the overbidding. You can see some areas like Cupertino, Sunnyvale at 123%, but that's sort of by itself. The rest are more in the high teens, low teens. 113% seems to be like the next group. Actually 15% in Campbell, Cambrian, Santa Clara, Willow Glen's at 115%. You can see there's a pretty big drop, and then after that they come in pretty close at 13.5, 12.7%, 13.3. And once you get off the very top, here we have the sale price to list price distribution graph. The purple line is the most current. If you look at each week, there is a fair amount of bounce, but the trend has been upward in the last 22 weeks. You can see the dotted lines here are at the bottom of the graph. Dashed lines are sort of next layer, and then the solid lines. Each group of those is getting more current, and the purples being the most current and also the highest pretty much across all the areas. You can see right here, the blue line dipped down a little bit, but it's not, the purple line's not down by that far, and it's some fluctuation. We're about ready to outperform April of 2018. I would call it equally performing up through here, not quite overperforming yet. but getting close. This is just the last 12 weeks, so you can see it a little bit better. But again, you can see the same pattern. The dotted line is the oldest 4 week, the dashed lines are the next. And this is what I'm sort of talking about, is there's some fluctuation. Here's a dashed line that is outperforming most of the solid lines. So it's not 100% true, but it's a general rule that the older ones are underperforming the middle ones, and the top ones are outperforming the middle one. The trend is generally up, but as I've been saying, there is some weekly fluctuation in that, with the solid purple line being the most current week. This is looking at the sale price distribution. Again, this concept is the same. The middle number is the median. That's what the color is assigned on. The number to the left is the cheapest 10 percentile in that area. The number to the right is the highest 10 percentile, the 90 percentile for that micro market area. You can quickly see what areas you can afford. This is the pricing over time for the median pricing, which is all most people follow, and obviously some data errors that I'll go back and try to correct. Here is the appreciation chart. And there's a couple things to take away. You can see some areas like the moderate low areas, which are North Valley, Milpitas, Berryessa, Santa Teresa, and Blossom Valley. They're at their all-time record high now with 31% appreciation over the 2020 pricing for the entire year, but they're the only one that's at their record. Everybody else is down, but you can see these numbers are all in the 20 percentile and above, okay? And then you go down to Santa Clara County and you're at 20%, and you go, how can that possibly be? You have a little bit of the shift of the marketplace. If you're selling homes, say more in the affordable areas, South County, Central San Jose, the moderate low areas that are all tend to be below the median price, that pulls down your median price. Anybody looking at this, each one of the components, there isn't a single micro market area that has below, what is it, 23.6%. So every area is appreciated at least 23.6%. So how can the county only appreciate 20.4%? That's one of the problems with statistics, is it's not telling you what's happening to property value. The countywide data impacts market mix as well. So if the low end is selling, that pulls down the appreciation. The micro market data is more accurate to what's happening with property values, but on the same type of concept within a micro market area, there can be market mix shift, and that doesn't necessarily reflect of what's happening to pricing in a particular micro market area. And that's why a CMA is important, where you get very similar properties and you compare the properties to the properties in your CMA to come up with market value. And that's one of the problems I see, along with the fact that most of the automated models don't even take into consideration the land value, which is the bulk of the price in Silicon Valley. There's all kinds of modeling, including what I'm doing, but modeling has its weaknesses, and you have to dive into the details in order to understand those weaknesses to really make an informed decision. In Santa Clara, in San Mateo County, single family homes, the appreciation is around 16%. Your lowest is 12.2, but again, their appreciation's down at 10% for the county. So again, some market mix area happening there. Now, just a week ago, it wasn't so pronounced because the countywide data was 16% appreciation, and you had several areas that were below 16%. So even just last week, this median was believable without accounting for market shift. Now it's not, because your whole can't be lower than your lowest number. And yet it is, and that's a strong indication of a market mix shift. Here is looking at the data. This is not completely comparing apples and apples, because if you look up here, this is January, and you come back here, I normally take the data on February the 5th. But we're only on to January the 8th, so how can I compare it? It's just to give you an idea. In a month from now, the median price last year was 1749. We're right there at that same number. Your days of unsold inventory are the same base. Your average days and median days on the market are basically the same as what they were. The average is a little bit higher. And what that just says is you've had a couple properties sell that have been on the market for a longer period of time. The median days is a little bit more meaningful, and the difference between 15 and 16 is zippo, especially because this is in February, this is in January. By the time we get to February, I would almost expect this to be a little bit lower, but there's no way to know. Inventory will be naturally higher at the beginning of February than it is now, but you can see you're at 220 from 538. I did not do this, and I meant to do it we got down to 155 single family homes in Santa Clara County. I think the previous record low was about 354. So you're 200 homes less than your previous record. And then you got the typical square footage, bedrooms and bathrooms counts of what this typical home is and the asking price. Moving on to offers. This is where you start getting meaningful data because this is telling you how quickly the market's moving. So you can see you're at 16.6 days unsold inventory. That is the lowest number on this table. Which way would DUI tend to move? I would actually think DUI will tend to move downward because right now it's high because of the holidays and no inventory to sell, but it's also almost impossible for me to believe that it will get lower than 15. So I'm going to say DUI will probably be stable around this number when we get to February. Sales will definitely go up. You're now low at 463. So this is where you have to have a little insight and not say, wow, we're not selling very many homes. This is for basically the time period over the holidays where if I wait till February the 5th, you're not going to have the holiday impact. And so that number is going to be significantly higher. Then you have the square footage in bedrooms and bathrooms count, and then you get down into closings. And when you get down into closings, you can get into sale price and list price ratio. So you can see that 110% of the sellers were getting more than asking price, and that's the highest number on here. I'd actually expect this number to get stronger as we get into February. Actually, I might take that back because January's closings are going to be the sales that were negotiated right over the holidays. So I'd actually expect this number to dip slightly, but I don't expect it to get down to any of these levels here. So we're probably going to have a record high. It might get close to 2018, which looks like it's 108.5%. The frequency of overbidding, I mean, that's super strong at 77%. It's the strongest on here. I'd actually, again, it's hard to tell which way this number is going to go. If I was looking at offers accepted in January, I'd expect it to be up. But you're looking at closings in January, which were offers accepted basically in December. I will also go with that will probably be stagnant. Then the median price you can see is up significantly from a year ago. I know all the different price categories. You can see the number of properties for sale and then the square footage. This is the same graph or table with different data. Here you're looking at the month of December, and this is comparing apples and apples because this was the data on January the 5th of this year. So now you can, and the reason I put the first one on that sort of forward projecting, this is looking in the rearview mirror because January 5th is in the rearview mirror and it goes back 35 days from there and it looks at closing. So you're going back 5 weeks from there. So you're actually quite a bit far back in the time period, but now you can at least say where were we? And with 13.4 days of unsold inventory, that's the lowest number on here by quite a bit. Your closest was 2017 at 18.5. And, 5 days may not sound like a lot, but again, as I've explained, once you start getting low numbers of days of unsold inventory, it's harder and harder to get lower than that. Yes, Foster City does have 0 right now, but the only reason it's 0 is there isn't a single house on the marketplace. It is hard to get below about 7, and that's because most sellers are going to want their home exposed for the weekend. So a listing gets put on the market on Wednesday, you hold it open through the weekend, you look at offers on Wednesday. By the time you report it as sold, that's going to have 8 or 9 days of unsold inventory. There have been micro market areas like Cupertino and Sunnyvale that have gone down to 5.5, I think even 5 even, a number where it's not going to get much lower than that. And again, Foster City is in fact at 0, but that's only because there's no listings at all. If there was one listing, the number would be extremely low. Number of sales, you can see we didn't sell as many homes as we did last year, but last year was the pandemic and you had some pent up demand. You had supply that didn't come on earlier in the year, so you had inventory to sell. I would maintain we simply didn't have the inventory to sell, and out of the other years, recent years, they outperformed both of those or equal to perform those, and you can see the numbers in this reporting period tend to be pretty low. The highest number you get up all the way back up here to 1,050, but that was coming out of the short sale meltdown when there was a ton of property available. There wasn't an issue of not having property on the market to sell. I think the reason this is decreased is not the lack of demand. I would not feel comfortable at all saying demand's off by 2 times what it was in 2010. I do feel comfortable saying that supply of inventory is going to be off dramatically. In fact, we can sort of look at what inventory was off. I have to move. So if you come back here to the peak sales, they had active listings inventory 2,228 properties versus 182. You can't sell 1,050 homes when you only have 182 to pick from. Here, you're selling only half your marketplace, which is why your that time to sell was at, your DUI was at 73 because there was so much inventory. Here, your DUI is 13. And if you had more inventory, I would maintain there would be more sales. Overbidding, I don't think we got down to that yet. So you're at 113% and 80%. And then the sale price down here, the 10 percentile, the median percentile, and then the 90 percentile. And with that, I hit my last slide, which is the URLs. And I'll pause to see if there's any questions. Not seeing any questions. I will go, and the current low inventory is 154. The previous low was about 300. So we're half the previous low, which is why we're having an impact on the number of transactions. All right. Take care, everybody. See you next week. Bye for now.